All right, so let's just go ahead and jump right into it. The first thing I want to do is introduce myself. For those of you that that don't know me, my name is John White, and I'll be teaching the class today, Collecting Theta. I'll tell you what that means and what this class is going to be about in just a few moments. And for those of you that do know me, and I know you, it's good to see you out with us here again today on this Monday afternoon. It's really, really windy here in West Virginia. When I say windy, I mean it's like just short of a tornado, just some weather getting ready to come through this afternoon. And so we live down in a valley here, and there's mountains on both sides of us, so you never know when a tree branch or something like that's going to take down the power line. So if we get a flicker in the power or it suddenly goes out, I wasn't raptured or anything like that. And well, it's possible, I guess, but it's probably just the power. The area we live in here, it's actually really bad for power outages, simply because, like I said, the mountains are very steep on both sides of us. So the entire community where we live with everyone else, it's I mean, any severe thunderstorm, you know, the snow in the wintertime, we get quite a few power outages just because the trees and mountains are so thick on both sides of us. So anyway, hopefully that doesn't happen. We'll make it through the hour without any problems. But I can hear the whatever decoration my wife currently has on the front door for whatever season. I'm sure it's still something from Easter, but I can hear it down there banging on the door as the wind blows right now. But either way, it's good to be out with you all here today. And what we're going to talk about today is I basically want to take you through some of the trading methods I use out there in the market, and I'll show you as much as I can here today in the next hour or so that we spend together. And don't forget that I will be teaching a class this coming Thursday at 8 p.m. That's April the 7th, this coming Thursday at 8 p.m. And my goal here today is to give you as good of an overview and a head start on the information that I'm going to be covering in that class. That class will be a 2-hour-long class, and we'll be covering as much information as we can possibly get through on these types of strategies that we're going to be talking about here. So collecting theta. I am strictly, I shouldn't say strictly, I am for the most part, for the majority of the time, a theta trader. And what I mean by a theta trader is I like to set myself up in positions that take advantage of that option time decay. And you know, we all know that all options, whether they're puts, calls, in the money, out of the money, at the money, and doesn't really matter what expiration we're talking about. It could be a weekly option, something that expires in 2 weeks, 3 weeks, or even a month, 2 months down the road. But we know that all options on the chain, every option on the board, undergoes that time decay, right? That theta bleed, or that theta burn, as you might hear me call it from time to time. And so what we want to do is, as theta traders, is we want to set ourselves up in positions and build trades that take advantage of that event. All right. Now, as we go through today's class, please remember that everything we do here is for practice trading only and to be considered educational purposes only. You remember everything the disclaimer says, right? Although we'll look at certain products and strategies, does not mean I'm telling you to trade those. And I don't have any trading restrictions on myself, so I could be in any of these at any time. So like I was saying just a few moments ago, what exactly is theta? It's that time decay that all options experience. And this is measured per day. Remember, if you're looking at the option chain and you see a theta of 25 cents, for example, that means that option is bleeding or burning 25 cents per day. And this changes. This changes all the time depending on the volatility, how far in the money or out of the money the option may go during the life of the trade. So this is not a constant. This, I mean, it's not like something where you see the option has a theta of 25 and it's going to stay 25 throughout the life of the trade. And you remember, if you go back to market essentials, or maybe back to some of the your early days as in your options education. Let me switch pin colors here. You remember a graph that looks something like this, where it kind of goes like that, and then it falls off, right? And that's the life of an option. I don't remember exactly what the graph's called, but it said something like a life of an option. And what that graph was referring to back in market essentials, this referred to as playtime. Remember that? And this graph was referring to buying options. If you buy options, when to do it and when not to do it. So this area here was kind of called the playtime area. But as we got from here down, This was called what? Do you all remember what that was? The danger zone, right? The danger zone. So this area here, this is actually where we benefit the most as theta traders, is in what we consider the danger zone for the option buyers. But we're not buying options here. We're going to set up trades where we are collecting theta, and I'll show you more examples of that in just a few moments. Okay, and like we said, all options, regardless of whether puts, calls, in the money, out of the money, they all undergo theta burn. And this becomes more and more so as we get closer and closer to expiration, just like that graph showed. Let me check the questions here. I've got a few questions coming in. Okay, Aaron's asking, do you ever take 50% of your max profits and ladder your trades? No, not really, Aaron. Not often. I'll show you why not in a few minutes when we go to some of the risk graphs. No, I actually don't really do that too often. Okay, so when we talk about trading theta, something we absolutely have to do is we have to stay on the positive side of that theta burn. And when I say on the positive side of that theta burn, think about this. If we know options are losing value on a daily basis, every option out there on the option chain that has life in it right now is losing value every single day. Some of them are losing value very, very quickly. Those are like the weeklies that we're in right now that expire this Friday. And then some are losing value very, very slowly, such as the longer term options like leaps or maybe something that's 3 or 4 months out. Those are losing value very slowly as far as theta is concerned. But all those options are losing some value. So what I like to do is I like to build a trade or build positions that the overall theta bleed is in such a manner that I'm the one being paid for that, right? If an option is losing value, everyone who owns that option is losing the value. Everyone who has sold that option is the person that's gaining that value. And that's where we want to be at in this kind of trading. Okay, so just for an example, before we get into some graphs and pictures and things here, if a trade has an overall theta, if I have an entire setup, now keep in mind a couple of things. Some of these trades we're going to look at, these are not always necessarily things that I just go out and just put on. I don't just go out and say, hey, I want to get into a trade today. These are things that I might construct piece by piece, one at a time, or maybe put 2 pieces of it on now and add another piece in, a week or 2 down the road. So keep that in mind. But if we construct a position that has an overall theta of a positive 100, that means that position, just for us to hold the trade, just for us to be there in that position, we are being paid $100 per day as the trader. Now, if we go on the other side of the coin, if we're in an overall position and our theta is negative 100, or negative 70, 80, 200, 500, whatever it may be. But in this example here, if it's negative 100, that means we, the trader, are paying the market $100 per day just to be in that position. All right, and folks, that's not the way to conduct business out in the market. We need to know that we are being paid some kind of income on a daily basis from that position that we got into, right? We're here to work. So we want to make sure that we're paid for the work that we perform. We don't want to have to pay our employer just to show up and punch in at the time clock at our own job. All right, we want to make sure that we're being paid to be there. So that's what keeping this theta positive is all about. Oh, it's okay. Some folks are saying the drawing with the pen wasn't showing up. I apologize for that. I did not know that. So anyway, what we were talking about here is becoming a theta trader and staying on the positive side of theta. So there's lots of different theta positive strategies out there, and a lot of you probably already are very familiar with a lot of these. We have credit spreads where we could just go out into the market and sell a credit spread. We could sell a bull put spread or a bear call spread on whatever stock or index we want to trade, and we collect premium for that when we sell a credit spread. So that's one thing we could do. And keep in mind, as credit spreads bleed their value, that creates positive theta. That's theta coming into our account. So that's one thing we can do. We could trade iron condors. All an iron condor is it's 2 credit spreads on the same underlying product. So if I sell a bull put spread and a bear call spread, both on the Russell 2000 index or on Apple or Tesla or whatever it is you like to trade, if I sell a credit spread above the market and below the market on the same product, that is considered an iron condor. And because we are bleeding value out of both of those credit spreads, that's considered a positive theta trade. All right. Another thing we can do, and I trade lots of these, some of you that have been to live classes with me or at TSS. By the way, don't forget TSS is coming up very soon, right around the corner. If you haven't registered yet, make sure you get there. We're going to have a lot of great folks speaking there, a lot of great instructors. I'm going to be sharing some new material myself, as are some of the other ones from what I've been told. So there's going to be lots of great information. So make sure and do your best to get down to Orlando for TSS. Hard to believe it's approaching so quickly. But I trade a lot of broken-wing butterflies and different ratio butterflies. Some of you are familiar with those. If you're not, you'll learn those soon enough as we cover this spread information in some future classes. But what we're going to be talking about here today are unbalanced condors. This is the theta positive trade that I'm going to share with you here today. We really don't have a ton of time to go through every little strategy that I use and when I use it, when I don't use it. But we're going to today mainly focus on unbalanced condors. Someone's asking, John, what products do you trade? I trade mostly indexes. I trade the Russell 2000 quite a bit. I'll trade the SPX. I trade the SPX more than just about anything. I really do. I trade the SPX probably 90% of the time. I do some trades on the Spider, the SPY. Once in a while, not that often, I might do something on the Qs. I haven't put anything on an individual issue in a while, like a Google, Tesla, Apple, Facebook, that kind of thing. I don't trade a lot of individual stocks. I usually stick to the broader-based indexes. That doesn't mean I won't trade stocks. I just normally stick with indexes because with stocks you have a systematic risk, which is if that's one company that you're trading comes out with really good news or really bad news unexpectedly, which is usually the way it happens, that stock can gap way up or way down overnight, and there's nothing you can do about it. An index isn't going to do that. If one or two stocks within the index comes out with really good news, the whole index isn't going to gap way up. It might be positive for the day, but it's not going to gap way up. Likewise, on the downside, it's not going to gap way down on bad news. So I usually don't spend a lot of time in the stock territory. I do stick with a lot of indexes. Okay, so and something I'll add to that is something to keep in mind, that there's no such thing as a perfect, like, super secret product out there to trade. I know a lot of folks get the idea that, well, so-and-so trades the Qs. That must be the best thing to trade. Or so-and-so trades Apple. That must be the best thing to trade. Or John trades the SPX a lot. That must be the best thing. That's not the case at all. So don't be lured into thinking that there's some magical product that is going to work great all the time just because it has some kind of magical property or anything like that. But so keep that in mind. So what I like to do with my trading, and this is what we're going to be focusing on the Thursday night class, is unbalanced condors. This is one of my favorite, if not by far my favorite strategy to trade out there in the market. And there's a few reasons why. An unbalanced condor provides us with a couple of things. Number one, it gives us income potential plus its positive theta at the same time. This is an example of an unbalanced condor. Now, what we have up top, this is a 2030, 2010 put spread that I'd purchased, okay? And I purchased that for a certain amount of money. Let's say I purchased it for $6 or so. Well, I know that if the comes through that 2030, 2010 put spread, now keep in mind, I bought to open a 2030 and I sold to open a 2010. So that's a 20-point wide spread that I purchased there. So I know that if the market comes through that spread, how much money could I make on that 2030, 2010 spread? And let's just pretend I paid $6 for that thing. How much money can I make on it if the market trades through and expires below that 2010 level? How much money can I make on that spread? I can make up to $20 minus the $6 or so I paid for it. Remember a few minutes ago I said I might have paid $6 for it. So I can make up to $14 on that, because the most I can make on a 20-point wide spread is the 20 points. So I have 20 points of potential income on that spread. But here's what I don't like about purchasing that put spread. If the market turns around and just keeps going north, what's going to happen to that spread? That 20, 30, 20, 10 spread that I own. What's going to happen to it if the market just heads north? Which is a great possibility. That spread will just expire worthless, and I could lose my entire $6 out of the trade, right? I could lose my entire $6. So right here, what I have is a spread that I bought, a 20, 30, 20, 10 spread. That's this one right here. And let's say I pay $6 for that thing. So I know that if the market comes through that spread, I can make up to $20 on that spread. All right, I can make up to $20 on that spread simply because that spread is a 20-point wide spread. So that's great. That's a good risk-reward ratio to have $6 at risk and be able to make up to 20 or profit 14, right? 20 minus 6 on that spread. But what might happen here is, what if the market turns around and it goes up instead? What if it goes that way? That $6 that I spent on that spread, that is going to go out worthless if I don't take some kind of action on this. And when that $6 expires worthless, it's gone forever, right? I can't get it back. And so that's the risk I take in being wrong. If I'm wrong on this trade, that's what could happen. I could lose that entire $6 investment, which is not somewhere I want to be. So what I'm going to do here in the case of this trade is I'm going to come down here further out of the money, and I'm going to sell some spreads against this. So what I did here is I sold to open 4 of the 1920s, and I bought to open 4 of the 1900s. And now, because of the credit that I received on selling these spreads down here, that credit a little more than pays for the debit I paid for this spread up here. So let's say now that I have this entire trade on for a 30-cent credit. That's not a lot, I realize that, and that's not where we're trying to make our profit at. But let's just say, for the sake of this particular example, that I got this thing on for a 30-cent credit. Most of these I like to get on for a small credit or maybe a small debit or about break even. All right? So this is an unbalanced condor that I have on here on a 1/4 ratio, right? A 1/4 ratio. And so what that means is that for every 1 spread I own here, I have sold 4 down here. So think about something now. What if the market decides to come down here and finish like at 1950? How much money will I make on the spread that I own? I'll make the full 20 points. What about the spreads I sold? Those will just expire worthless. So on one contract, I can make $2,000 here on this particular trade, right? $2,000 on this one particular trade on one contract. Now, what if the market decides to go up to, like, let's say 2050, and everything here goes out worthless? What's going to happen there? Well, am I really going to lose any money? No, because I put the thing on for a 30-cent credit. So even if I let the whole deal expire worthless out of the money, I haven't lost anything because I put the entire trade on for a credit. All right? Something else to keep in mind is that this is, what are we here to talk about today? This is a positive theta trade. So what if the market just kind of flutters around and goes sideways? What if it gets in a channel and just goes like something like that? Well, what's happening there is that I'm still collecting that theta burn, because these spreads down here that I've sold, these are losing value very, very rapidly, and that's good because I sold those, right? I sold to open those. So those are losing value very rapidly, while this spread that I own, it's holding value. It's losing some, but not nearly at the pace that these down here are losing. All right? So the product that I own right here is holding its value. It's retaining its value, while the products that I sold down here are losing their value. That's what creates that positive theta environment. Any questions about that? I know it's a little confusing if you're not used to looking at multi-spread combinations like we're looking at here, but this is just kind of like a plain vanilla example of what a simple unbalanced condor might look like, and this is on a 1/4 ratio. So we bought one contract of the 2030, 2010 put spread. And remember, I bought the 2030. That's why you see the little +1. And I sold open the 2010. That's why you see the -1. And if you get down here to the credit side of the trade, I sold 4 contracts of the 1920 and bought 4 of the 1900. So that's why this is the debit side of the trade, or the income side, and this is the credit side that we use to pay for it. All right? So, and both of these are puts, James. Absolutely. Absolutely. Both of these are put spreads. But, James, keep in mind, the 20-30-10, that's a put debit spread that I purchased, and the 1920, 1900, that's a put credit spread that I sold. All right? So here we got on 30 cents credit. Now, here's the thing. Am I hoping the market goes up, down, or sideways in this trade? Somebody tell me, what am I wishing happens here? Up, down, or sideways? Where do I want the market to go? I really don't care. I really don't care where the market goes. If the market goes down, I know that I'm going to make 20 points on my spread. That would be like a home run situation, right? So that would be great if that happens, but I have no guarantee that's going to be the outcome of this trade. I don't know that the market's going to go down and expire down in here somewhere. It could go down right there. It could just go sideways. It could just bounce and keep going straight up. I really don't know what the future holds, and I really don't care where the market goes, because in any direction the market may go, I have a trade here, a position that I've built that I have a really good chance of being profitable on, especially if the market goes up. There is no upside risk to this trade. If the market goes straight up, I'm in no danger of losing any money, not a penny on this trade. If the market goes sideways, I'm in no danger of losing money. If the market comes down, no danger of losing money. Only if the market comes down really, really steep and gets close to my credit spreads, now I have some things to be concerned about and some areas I need to manage, right? So yeah, Wayne's asking, John, well, what if that happens? What if it comes down too far? What are you going to do then? How do you adjust it? Well, Wayne, think about this. If the market comes down too far, where's my risk? My risk is at 1920. That's where my risk really starts. So I'm going to have to do something to my credit spreads. Now do something. What is something? Well, lots of different things. I could just shut them down and roll them lower. I could do something like that. Okay, that's one choice I have. I could butterfly them off. I could come in here and buy like a 1920, 1890, 1870 butterfly and butterfly them off. That takes the risk out of it. I could come in here and add in another put debit spread that I own. That gives me more income. So if the market falls on through here, I have 20 points of income here, and if this is a 20-point wide spread, I've got 20 more points of income there. So that there's lots of different ways I could adjust that, and how I adjust it depends on how far we are from expiration, how fast is the market falling, do I think it's going to fall even further. That's where those different variables come into play there. But something you have to keep in mind, any adjustment I make to this is going to require a cost, right? It's going to require some money. But isn't it true that if the market has fallen down far enough to make me have to adjust this guy here, what have I made in the meantime? I've gained my 20 points of income there on that 20-point wide spread. All right. So Aaron's saying, John, wouldn't you prefer to unwind your position once the market went through your upper spread, then your risk is gone? Well, Aaron, here's the thing. I'm not sure what you mean when you say unwind, but if the market goes through there and I sell back this spread here, that's fine. I can do that. I could sell that one back for a really nice profit, guaranteed, right? I want to sell that one back for a profit if the market falls through it. That's an absolute guarantee. But here's the bad thing. If I sell back these spreads and I still own these, or I'm still short those, I've still sold those, then I have risk at the downside. If the market keeps on coming down, then I've sold back my income. up here. But before I've had a chance to gain all of it. Before I've had a chance to gain all of it. Okay? So, Wayne, I appreciate that. Thank you. I've never been called that before, but that is a compliment. Thank you. I really do appreciate that. But here's the thing, folks. Here's the big idea I want you to get. We'll go through all these details on Thursday night when we have, and we've still got a little bit of time here today, and I'm going to show you some more things before we have to get out of here. But we'll go through all these little fine details later. But here's the thing. I'm in no danger if the market goes up. No risk at all. I have no risk if the market goes sideways. I'm not even concerned if the market comes down. The only thing that concerns me is if the market crashes. When I say crashes, I mean really falls apart, when things really get ugly. But even in that scenario, in this one scenario here that I might, have some concern about, even in that one scenario, I can handle that because as the market falls through this spread up here, I own that. I'm going to make 20 points. Why 20 points? Because it's a 20-point wide spread. If it was a 30-point wide spread, I would make 30 points. If it was a 15-point wide spread, I would make 15 points. You can't make more than the width of the long spread. And the long spread is 20 points wide, 20, 30, 20, 10. So I can't make more than 20 points. It's impossible. All right? I'll be maxed out profit-wise at 20 points on that spread. But what this 20 points does, on one contract, that's $2,000. That $2,000 gives me income that the market is paying me, right? It gives me income to shut these down and roll them lower if I need to butterfly them off, to maybe use some kind of unbalanced condor and come in here and do something. Maybe I just want to come in here and purchase some more income potential, purchase another 20-point wide spread. That's going to cost some money, right? That might cost me $700 to do. It might cost me $700 to come in here and buy that. Do I have $700? Yes, I have $2,000. The market's just paid me, right? So that's how I like to trade these things. Now let's look here on a risk graph. I hope you can see this all right, but let me pull this up. I'll go to full screen on this one and see if I can draw on it. Okay, Lord, please. Can you all see that? Yes or no? Can you all see that little circle I just drew there? Yes, thank goodness. There we go. All right. So it's working out now. So here's a picture of a risk graph. This is just a screenshot of a risk graph, and I use risk graphs in all of my trading. I don't to trade without one is kind of like flying your airplane without being able to see your instruments. So I never trade without risk graph. I graph everything I do. And so what we have here on this risk graph, if you look, concentrate up here with me for just a moment. And if you don't know how to read these things, I will teach you how to go through these and understand them. They're actually very, very simple. They look complex, but they're actually very simple once you learn how to read one. But what I'm going to show you here is the 2030, 2010 spread that I bought. And you can see right there, I bought one, sold one. And there's the prices. You see that? And then right here, these are the four that I sold of the 1920, 1900, and there are the prices. Those fields red on this example. So I'm in this thing for a 30-cent credit on this trade. Okay? A 30-cent credit. Now, this is what it looks like on the graph. This little dotted line, this little white dotted line right here, that's the zero line. This is everything below here is a loss. Everything above here is a profit. This is the value of the market. At the time I took this, the market was at 2035. So the x-axis has the value of the market, where the market currently is, and the y-axis has the profit loss. Okay? So what we have here is we have a graphical, I don't know, you say graphic. We have a graphic representation of what the trade looks like. So right here, that slope, that is the 2030, 2010 put spread that I own. Right there's the 2030, and right there's the 2010. That's that put spread that I own. Right here, this is the 1920 put that I sold down on my short spread side, and here's the 1900 puts that I bought. Okay, so again, here's the spread that I own. Here's the 4 contracts of the spread that I sold. And it doesn't matter to me where the market goes in the meantime, but as you can see here, if the market finishes anywhere below 2010, that's 2010 right there. If the market finishes anywhere below that, basically if it finishes anywhere below 2010 but above 1920, anywhere along this green mountain, you see that green mountain it created? See that green mountain the trade built? If the market finishes anywhere within that range, I'm going to make exactly how much, and I'll erase some of this and redraw it for you. I want to make exactly $2,000. You see that? And the reason is, if the market finishes anywhere between 2010 and 1920, if the market finishes anywhere between those marks, my put spread that I own is going to be completely in the money. My 2030, 2010 put spread is going to be completely in the money, and I'll cash it out for its max $20 value. $20 on one contract is $2,000. You see that? Now, when you look at all this here is the most important thing on this entire graph, right there. You see that? That's the most important number out of all these Greeks. That's the most important number on this entire graph. That 16, that means this trade, and this is only a 1 contract example. Keep that in mind. This isn't, like a 10, 20 contract example. It's only a 1 contract example. That number, this is what you're getting paid per day to hold that position. Let me repeat that. That's what you're getting paid per day to hold that position. Now, if that was a negative number, if this was a negative number, that's what you're paying to hold that position. And there's no reason for you to be here if that's the case. All right, so that's what you're getting paid to hold that position. So if this were like a 10 contract example, if this were a 10 by 40 instead of a 1 by 4, that would be $164 per day. And that number increases as we get closer and closer and closer to expiration. That number keeps increasing because of that theta burn. So everyone understand that? It's okay if you don't understand everything you're looking at, but do you understand the big idea of why I would set up a trade like this? Because I'm getting paid this much per day to hold that position. If the market goes up in value, I have no risk. If the market stays right in here, no risk. Now, if the market starts going down really fast, well, now I have some risk. But I can adjust that. I can always adjust that. Dan, the 4 legs are positive theta because those are credit spreads that I sold. So let's look at it this way, Dan. Those 4 legs, which are represented right here, those 4 legs, that's a credit spread that I sold. I sold 4 of the 1920s, and I bought 4 of the 1900s. So I'm short credit spreads. So what that means, Dan, if I go out and I sell those things for $4,000, those are out of the money credit spreads. So those are bleeding value. So if they bleed $100 today, if I sell them for $4,000 today and the theta on those is 100, by tomorrow they're only going to be worth 3,900. In 4 days from now, the value of those spreads are going to go from 4,000 to what? 3,600, assuming that we're bleeding $100 per day. And so that's getting that theta bleed is getting more and more severe the closer we get to expiration. All right, which is exactly what we want. So let me take you out of something here and show you something else. Give me just a moment. Okay, so right here, this is options analytics. This is just the trade I want to show you here to analyze. Give me just a moment. Let me pull this back up. I want to share that. Okay, there we go. Can everyone see that graph? Everyone should be able to see that risk graph okay. Can you all see that? Okay, good, good. So here's this exact same trade. This is the exact same trade here. And what we have here is a trade that, again, and I'm going to mark this up some. Here's the put spreads that I bought. There's the fill prices. Here are the 4 put spreads that I sold. There are the fill prices. So this thing was put on for a 30-cent credit. Now, what I want to show you here is you see this solid purple line. That solid purple line is the profit loss on expiration. Okay, that's the profit loss on expiration of this trade. Right? So let's say the market finishes right here at 2,000. Now, when I say 2,000, I'm referring down here to the bottom value. So let's say the market expires at 2,000 on expiration day. How much will I make on this trade if the market expires right there at 2,000? Well, if you look over in the right-hand column, over on the y-axis, I'll make exactly $2,030. $2,000 because my put spread that I own is in the money and it's worth 20 points or 2,000 bucks. The $30 comes from that 30-cent credit that we put the trade on for. So if the market expires at 2,000, we'll make exactly $20.30 on this example. Well, what if the market expires down here at 1950 on expiration? We'll still make $20.30. You see that we'll still make $20.30. Okay. What if the market expires at 1971.52? We'll still make $20.30. You see that because the put spread that we own, this one right here, this one is in the money. That one is in the money and it's worth $2,000. It's worth $2,000. Now, something else I want you to take note of here is you see this little dotted line that I'm tracing over with the cursor? That's the current profit loss. That's the current profit loss. So right now, although the market has gone up away from my trade, this thing currently has $195 profit in it. Even though the market went completely up, it went the opposite way, the trade has $195 profit in it. And again, this is just a one contract example. But what you can see here is that also right now, if the market would fall down to 2,000 by the end of this week, let's say we just get some really bad news and the market has a big retracement. If the market pulls back to 2,000, how much current profit would this trade have in it? It would have about $1,400. Do you all see that? Give me a yes if you see what I'm tracing out there. If the market would fall down to 2,000 by the end of this week, I would have about $1,400, $1,403.74 to be exact, according to the risk graph. And if the market fell on down to 1975 by the end of the week, I would have about $1,585. You see that? About $1,585 in that. Okay, very good. Yeah, folks, these things really aren't hard to read. They're actually, it's actually a very simple tool, but you just have to know how to read them. All right, just have to know how to read them. So that in a nutshell is what this kind of trading is about. Now, there's a lot more to this. There's a lot of other details and bells and whistles we can add on to these trades to increase the theta, right? To increase that number right there, to make that number bigger and bigger and bigger. That's what we want. We want to milk this thing for as much theta as we possibly can. But it's just a really, really nice way to trade because we're not at the mercy of being right all the time. And that takes a lot of pressure off of us as traders. That takes a lot of the stress off of us, not being at the mercy of being right. I mean, how is it when you go out there and you trade and you jump into a trade and you say, okay, the market's bouncing. I know it's bouncing. I'm going to jump in and buy the stock right now. And the first little tick, the market goes down, you start sweating, right? You start sweating. You start getting anxious. You start, wringing your hands out. And there's no reason for that. There's really no reason for that. This should be a calm smooth exercise here. It should not be an exercise in frustration and anxiety, right? So we like to keep ourselves as cool and calm and collected as possible, and that's what we do. That's what we do with this kind of trading. Let me go back here to there. Okay, good. That's where I want to be. Perfect. So, you know, again, if the market decides to come down, that's fine. That's fine. I might come in here and buy some more spreads right there. I might buy another 20-point wide spread. So I've already made 20 here. I might buy another one. If the market comes on down, now I have 40 points of income, 20 and 20. I have 40 points of income total. And then if the market keeps coming down and I have to roll this one lower to move my risk further down, or just butterfly the thing off, just shut it down, whatever, I have $4,000 of income here, right? I have 20 points on two different spreads. That's $4,000 of income that I can use to pay for whatever defensive move I might choose to use on that. Okay, so just an awesome way to trade. This is the kind of trading I do, folks. So those of you that follow my market insights, we do this kind of stuff, you know, pretty much day in, day out. In the market insights, we put on practice trades just like this, and of course, there's a lot more we could do to these. We could sell some calls against the trade to bring in some more premium. We could. What if, check this out, what if the market, what if we put this on and the market just went straight up and it just kept going up and going up and going up? What could we do to milk more profit out of this? Well, we could shut these down because they're going to bleed out very quickly, right? We could shut them down and roll them up and resell them up here somewhere. That's going to bring in even more credit. What if I can do that and bring in $1 credit? Well, now I don't just have 30 cents credit that I put the trade on for. Now I have $1.30 because I collected an extra dollar here to roll those up. You see, so in every scenario, whether the market goes up, whether it goes sideways, or whether it goes down, we have choices that we can make. We have choices we can make to defend ourselves. We have things we can do to massage more profit out of the trade. And keep in mind, there's no risk at all. There's zero risk on two sides of this. On this example, the upside, the market going up, there's no risk to us. There's no danger at all, no matter how high the market goes, and there's no risk to the market going sideways. The main concern we have is the market not going down. I would love if that happened. I would love if the market came down, as long as it did it at a nice, steady pace. What I don't want is, you know, oh my goodness, let's all go jump out the window. That's what I don't want. But if that happens, there's adjustments I can make to this, like we talked about before. All right. So just a really cool way to trade. Really cool way to trade. But folks, I tell you what, that is about all I have for you here today. So let me give you some information on the and where in the world did it go? I don't even see my my last slide. It's not on. Boy, I tell you what, I have had more technical difficulties today than ever. I don't even see my last slide on here that gives you the time and the date. But write this down. April the 7th. That is this coming Thursday. Okay, it's this coming Thursday. And I pulled up the store there. I'm going to be teaching a 2-hour class on unbalanced condors. That's the one example we just looked at. And folks, there are just many positions like this that we can put on and learn to trade. But this is where we're going to start. I think these are the cleanest and easiest to understand. So we're going to start out with these guys here. So I'll be teaching that class Thursday, 8 to 10 p.m. Eastern Time. And you can get registered right here online. You can click the link that the web shop administrator put into the chat there. You can click that link, and it will bring up this unbalanced condors, and you'll get the promo and all that. And the class is only $129 for the 2-hour class. Only $129, and don't forget, you will get a recording of the class, all the slides, everything that comes along with it. And that's for only $129. Now the recording lasts, I think it's 30 days, if I'm not mistaken. The recording lasts 30 days, so you can go back and review it as much as you need to for the next 30 days. Okay? Folks, we're out of time. Any last-minute questions before we cut out of here? I apologize for all the technical difficulties today. I don't know what's going on, but we've had one thing after another, it seems, not working right here today. It might just be something on my end. But any other questions or comments at all before we cut out? We only have 5 minutes left before the thing will shut down on us. So you're very welcome, Wayne, Andrew, all of you are. Yes, you are very welcome. It's my pleasure to come out and share this with you. It really is. So very, very welcome. Yes. All right. Well, folks, I will see you there Thursday night, just a few days down the road, and we'll be doing this again but we'll be doing it live. We'll be doing it together for the full 2 hours and going through all this. All right. Well, I'll catch up with you all then. Everyone have a great day, and I'll see you all in a few days. Bye-bye.